These are in listen-only mode.
Good afternoon. My name is Todd Ensign, tax partner with the national accounting firm of Capin and Crouse, and we're streaming live to you today from the heartland of the Midwest, Indianapolis, Indiana, and we get to host the 2012 Super Bowl this year, and so we are looking forward to that, and a lot of exciting things going on downtown Indianapolis, and we were hoping the Colts would be able to be there this year, but with Peyton Manning out, that's not working very well. I'm excited to be with you today, and I'm looking forward to spending a short hour of our time together, and I'm wanting you to walk away today with a clearer understanding of basic minister's tax issues, and I can't wait to get started. Let me just say a few words about Capin and Crouse. We specialize in serving churches and various Christian ministry organizations, Christian colleges and universities, mission organizations, and other similar exempt entities, and that's really our heart, and that's our passion. And Capin Crouse also specializes in providing tax consulting and tax preparation services to ministers. We swim in these waters every day, and it's our privilege to be able to share with you some of the insights and understanding we have gained in our years of service. Now, as we step through the information today, it should be packed full for the entire hour. I've provided you with my contact information at the end of the presentation. Feel free to email me with any questions you may have. Let's begin today with a story. Everybody loves a good story, and the story we're going to share is one that is all too common in our tax preparation services for ministers. And let me introduce you to Reverend Newby. Reverend Newby is excited. He's just completed his first year of being a newly ordained minister. He received a housing allowance for the first time, and the ministry is really going great. And as a matter of fact, he's so busy that time has just flown by. And it's April 1st of the following year, and the April 15th personal income tax deadline is looming right ahead of him. And so Reverend Newby is hurriedly gathering all of his tax information and together so he can prepare his returns. He's prepared his returns in the past. They weren't that difficult, and he was thinking that ministers' tax issues can't be all that complex, so he was just going to go ahead and prepare his return this year. And so he got looking in the instructions to the tax return and started reading more and more about ministers' tax and became more and more confused the further he read. And what is this housing allowance all about? I just don't understand that. And so he heard about Capin and Crouse and thought that it would be good to seek the professional tax preparation services of somebody who knows what they're doing with ministers' tax returns. And so he gives us a call, and that's me in my younger days with lots of hair. And I think you'll probably understand when we get to the end of the story why I don't have any more hair and why what I do have is mostly gray. Now, that's really not me, but I think you understand. And so Reverend Newby is explaining his situation to me and newly ordained ministers. He's received a housing allowance, has a W-2 that just doesn't look the same as the W-2s he's received in the past, and he's a little confused about that. And he was going to do his tax returns, but just doesn't understand ministers' tax that well. And the April 15th deadline is just ahead. Can you help me? And we say, sure, we can help you. But my smile turns to a look of concern. And Reverend Newby and I exchange pleasantries, and we tell him to bring his information in to us, and we'll get his returns prepared. And my posture changes after we get off the phone to one of prayer. And I'm praying, Lord, help Reverend Newby because he's going to need it when he files his tax returns. We've seen the situation so many times before, and it's not a good situation. So Reverend Newby brings in his information. We prepare his tax returns for him, and then we call him in and meet with him so we can discuss his return. And he's very happy to be able to sign his first tax return as a newly ordained minister, and we try to go along with his enthusiasm at all the while trying to explain the intricacies of minister's tax. But ultimately, when we get to the end of our conversation, we ask Reverend Newby this question: do you have any extra cash hanging around? Because you're going to need it. In fact, Reverend Newby, you owe a huge chunk of change to the IRS. It amounts to thousands of dollars. And Reverend Newby's smile turns to a look of despair. How is he going to come up with all that money to pay the IRS in such a short time? Well, we at Capin and Crouse, in league with the American Anglican Council, want to put a stop to these types of looks by ministers on April 15th. And just how can we get that accomplished? Well, welcome to the Information Highway, and welcome to the three-part webinar series on clergy and their taxes. Would you pray with me? Heavenly Father, thank you for being with us today, and thank you for each person who's listening to this webinar. Ministers' tax issues can be very complex, and I pray that you would give us wisdom and understanding as we navigate these waters today, and thank you for doing that. And Father, I pray for each person that is listening today that they would be blessed, encouraged, and strengthened to serve you. And it's in Jesus' name we pray. Amen. This is a three-part webinar series. Today, we're going to talk to you about the basics of ministers' taxation. In January, we're going to provide you with the latest personal tax and legislative updates as they affect individuals and how that relates to particularly to ministers. In February, we're going to provide you with tax tips, some do's and some don'ts, and what the IRS looks for. So we're looking forward to providing you with very relevant and up-to-date information that's going to help you in the tax filing season approaching. Now let's get started today with the basic minister's tax issues. And let's shoot up in the atmosphere and look down at the tax world. There's a lot going on planet tax. Why individuals have to pay property tax. Every time you fill up your vehicle with gas, you're paying fuel tax. When you go buy something, you're paying sales tax. When you get your license plate put on your car, you're paying tax. In Indiana, we have to pay an excise tax and a county wheel surcharge tax. There's Social Security and Medicare tax. The individual has to pay income tax to the federal government on Form 1040. Many states have income tax that individuals have to pay, and even within those states, there are cities and counties that you have to pay income tax to. And then there's self-employment tax, or the SECA tax that individuals have to pay. Why, there's a lot of tax out there, and there are even more than this. But today we want to narrow our discussions down to two types of tax. We want to talk about income tax and Social Security and Medicare tax, and particularly how it relates to ministers as compared to lay employees. First, let's talk about the income tax. As you know, the individual income tax is prepared on Form 1040 for the IRS, the federal government, and individuals report their income on the Form 1040. There are some deductions that you get to take and some credits, but once you do, you get down to your taxable income and you compute your tax that you owe, and then you compare that against the amounts that were withheld and or any estimated tax payments you paid, and you end up with a refund or a balance due. Now, this is the same typically for lay employees and for clergy. There's really not much difference. Let's move to the second type of tax, Social Security and Medicare tax. Who pays Social Security and Medicare tax? Employees, and employers match what's withheld from the employees, and this we're going to refer to as lay employees are paying this tax. Also, self-employed individuals pay Social Security and Medicare tax into the IRS, and ministers are treated as self-employed for Social Security and Medicare tax purposes, and we'll expound upon that just a little bit. Employees and employers pay the Social Security and Medicare tax in through the Federal Insurance Contribution Act, or what's known as FICA. The tax consists of Social Security and Medicare tax, 6.2% for Social Security and 1.45% for Medicare, for a total of 7.65% for the FICA tax. Lay employees are responsible for the 7.65%, but employers are also responsible to match that amount of 7.65%, so the government is ultimately getting 15.3% for Social Security and Medicare. Let's look at a lay employee's W-2. They had wages for income tax purposes of $80,000, Social Security wages of $80,000, and Medicare wages of $80,000, all the same for simplicity's sake today. The individual had federal income tax withheld of $10,000. Social Security tax is 6.2% of the $80,000, or $4,960. And the Medicare tax is 1.45% of the $80,000, or $1,160. So all of this tax was withheld from the employee's wages. Now the employer has to match the Social Security and Medicare tax withheld, and they remit that to the government as well. So the IRS is receiving tax withheld from this employee's paycheck and the employer's match of $22,240. This is the lay employee. Again, who pays Social Security and Medicare tax? The employees, lay employees, and the employer's match, and self-employed individuals who are ministers. Now, the self-employed individuals pay the Social Security and Medicare tax in through the Self-Employment Contribution Act, or what's known as SECA. The interesting thing about self-employed individuals is that they are both considered the employee and the employer. So self-employed individuals are responsible not only for the employee portion of 7.65%, but also the employer portion of 7.65%. Self-employed individuals have to pay in 15.3% to the IRS. Now, let's talk about how ministers and lay employees pay their Social Security tax and Medicare tax, and then we'll talk briefly about the housing allowance. Again, let's look at a lay employee, and let's revisit this $80,000 of wages for income tax purposes, Social Security wages are $80,000 and Medicare wages are $80,000 and the resulting tax. But now let's look at a minister's W-2 and see how it's different from a lay employee. Here's Reverend Newby, just received his first W-2. Notice he has wages of $80,000 for income tax purposes. He did have some amounts withheld of $10,000 in federal income tax. But notice box 3 and box 5, Social Security wages and Medicare wages, and the resulting tax is all zero. The minister did not have any Social Security or Medicare tax withheld. So is a minister not subject to Social Security and Medicare tax withholding? That would be great, but that's not the case. Remember, we're talking about how ministers pay in SECA tax and how that's different from an employee. Again, the church pays for a lay employee. They withhold and remit the tax on behalf of the employee and also remit the employer's portion, but ministers do not have FICA tax withheld. So how do they pay SECA tax in to the government? Again, ministers are considered self-employed. They pay both portions of the tax. So how and where do they pay that? What form do they pay that on? Again, for income tax purposes, ministers are treated as employees, but for Social Security tax purposes and Medicare, self-employed, the FICA is not withheld on their W-2. So they've got to pay it in somehow. So again, look at the wages for Reverend Newby, $80,000 for income tax purposes. They're treated as an employee, but for Social Security and Medicare tax purposes, they are not treated as an employee, but as self-employed. Now, here's a Form 1040. It's truncated, but look at line 7. This is where wages are reported on Form W-2. Remember, Reverend Newby received an $80,000 W-2. So we add it to line 7 of Form 1040. And we go to the next page, and you get to reduce your income by itemized deductions and reduce it by exemption deductions. And so you get down here to federal taxable income of $52,048. And here's the federal income tax. It was computed on the taxable income. But remember, we're talking about how a minister pays in Social Security and Medicare tax and the employer's portion. Go down to line 56. This is self-employment tax, Schedule SE. This is where a minister computes his self-employment tax. He adds the self-employment tax on line 56, adds the federal income tax that was computed, and this is the amount of tax that the minister has to send in to the IRS. In our example, Reverend Newby had federal income tax withheld on his W-2 by the church of $10,000. And now, Reverend Newby owes $8,273. This is the reason why we have so many chins on our table on April 15th, wondering why they owe so much to the IRS. And line 56 is the reason. Because normally, ministers or lay employees do not have any amounts on line 56 if they don't have self-employment income. And it's zero. But when you switch to a minister, all the tax now is paid by the minister and is added to line 56. And that's why there are huge surprises when new ministers start filing returns. Again, to recap, for income tax purposes, ministers are treated as employees, but for Social Security and Medicare tax purposes, as self-employed. Now, how can ministers pay in their tax? Well, they have options. You can have amounts withheld from the church and remitted to the IRS on your behalf. You can pay in estimated tax payments on a quarterly basis due April 15th, June 15th, September 15th, and then January 15th. Or you can do a combination of both. And we have ministers that do all three. My opinion is that withholding by your church is much more administratively easy to take care of because you don't have to send in quarterly vouchers to the IRS with estimated tax payments, and the withholding is taken out ratably, evenly over the year, and it's very easy for a minister to be able to budget personally that way. So, but you can do any method that you want or a combination of both. But please understand that you can apply any amounts withheld by the church and any amounts in estimated tax payments you make against the income tax and the SECA tax computed on your tax return. So very quickly, let's look again at this example. Here's a federal income tax. Here's a self-employment tax. So here's the total tax that's owed. Reverend Newby had $10,000 withheld. So he can apply that withholding against both the SECA income and the federal income tax. So if he actually would have had $20,000 withheld by the church, he could apply it against the $18,273 owed of both SECA and federal income tax, and he would have received a refund. The same thing applies to estimated tax payments that you include on line 62. They can both be applied against either tax. So again, one more time to drive the point home. For income tax purposes, ministers are treated as employees, but for self-employed, they are treated as self-employed. But now you're saying, this doesn't make sense. Why would I even want to be classified as a minister for tax purposes when I have to pay an additional 7.65% into the government myself, when normally the employer pays it in? And you know what? You're thinking correctly. And many churches understand this, and many churches supplement ministers' wages for the employer portion of the self-employment tax. So they'll just add, give the minister a little bit more income to compensate for that. Not all churches do that, but some churches do. But stop and let's think a minute, because there's another factor that comes into play with ministers' tax that levels the playing field and is a great tax benefit for ministers. And you all know what that is, and that is the housing allowance. Let's talk real quickly about the housing allowance and who is eligible. Well, you have to close the deal to find out who's eligible. You have to either be commissioned, licensed, and or ordained, and you have to be able to perform sacerdotal functions, provide worship, or administer sacraments. It doesn't have to be all of them, but a combination or a certain number of them in order to qualify. And once you do, you're eligible before the IRS and qualify as a minister. We're going to assume for these purposes that all of you understand this and qualify as a minister. What does a housing allowance do? Essentially, the housing allowance reduces your reportable income and ultimately reduces your taxable income, which will decrease your income tax. But please note that a housing allowance does not reduce your SECA income, nor does it reduce your self-employment tax. Again, the housing allowance can reduce your reportable income and ultimately reduce the amount of income tax that you're paying on your personal return. That's great news, yes, great news, but how does it do that? Well, first you have to designate a housing allowance as a minister. Let's assume this entire pie is your compensation package as a minister. Well, you need to designate a portion of that or all of it as a housing allowance. How do you do that? Well, the timing of your deduction is very important. It's very important to make sure that you have the housing allowance designated before the beginning of the year. You can't get to March 1st if you were a minister at the beginning of the year. Have your church retroactively back to January 1st designate your housing allowance. That doesn't work, and it's not allowed. It must be approved by your church, and it must be contemporaneously substantiated by in writing or in the church's minutes, documented in their minutes. So these are vital to a properly designated housing allowance. Now, there are ministers that are ordained in the middle of the year, and so if you have a minister who's ordained June 1st, they can designate a housing allowance starting on June 1st and moving forward to the end of the year, but they can't retroactively designate one to the beginning. What if you forgot to have a housing allowance designated? Sorry, but you lose the potential for a housing allowance deduction. There is a futuristic designation that one can make. You can go to your church board, have them designate a housing allowance. Let's say it's going to be $40,000 a year, and you say, okay, I want to designate a housing allowance at $40,000 a year starting this year and all future periods. You can do that, and that will help you to avoid the oops, I forgot scenario. But don't rely on that as a long-term substitution for the annual housing designation. Please try to do that every year, but this can help in that instance. What happens when you designate a housing allowance? Your reportable income is going to go down, but how does that happen? Let's dig in now a little deeper into the housing allowance. It's starting to get a little bit more complex, but you're doing a great job hanging in there. So after you designate, what happens? The W-2 changes. Remember, a housing allowance decreases reportable income, and reportable income is included on the form W-2. So it makes sense that the reportable income on the W-2 is going to go down as a result of designating a housing allowance. Let's look at two examples. You have Reverend Newby, who received a total ministerial compensation package of $80,000. He forgot to designate a housing allowance. So when the church secretary issues the W-2 at the end of the year, he gets a W-2 for $80,000 in box 1. After all his deductions and credits, the tax computed on the $80,000 is $6,969. Now let's move to example number 2. Reverend Newby attended the webinar series, and he learned that designating a housing allowance is vital to helping him reduce his income tax. So he goes to the church board and has them designate $20,000 as a housing allowance. The church secretary issues the W-2 at the end of the year, reduces the total compensation package of $80,000 by the $20,000 housing allowance, and the W-2 is $60,000. That's great. After all the deductions and credits, the tax computed on the $60,000 is $3,969. That's a tax reduction of $3,000 just by designating a housing allowance. Now let's look at a W-2 for a minister who has a housing allowance designated of $20,000 with a compensation package of $80,000. Remember, the wages and tips go down to $60,000. The housing allowance can be reported in box 14 of the W-2 as other information, but it's not required. Now, let's look at example 1 and example 2 where the Reverend Newby had $80,000 of W-2 income on the Form 1040. In example number 2, after designating a housing allowance, it dropped to $60,000. So let's go to page 2 where you figure your taxable income. And here's the first example and the second example. You take off your deductions and you reduce it by your exemptions, and now you get down to taxable income, which without a housing allowance is $52,048. With a housing allowance designated, it drops to $32,000. And here's the resulting tax, federal income tax. So a housing allowance has the effect, can have the effect, of reducing your federal income tax. But notice your self-employment tax down on line 56. It does not change nor reduce your self-employment tax. That's good news. And that levels the playing field for ministers. But now you're thinking, I want the whole pie. Why designate just a portion? Why not designate my entire ministerial compensation package as a housing allowance? I can do that, can I? Well, it depends. How much should you designate? If I can designate the entire amount as a housing allowance, I can exclude it from income, and I'm scot-free on paying income tax. Well, the IRS is not going to allow you to carte blanche deduct all of your, exclude all of your income from taxation just because you designate it as a housing allowance. So the IRS has set up limits. So first, let's understand the IRS limits on how much you can exclude from income. This will help you to know how much you might want to designate as a housing allowance every year. The IRS limits the amount you can exclude from income, and it's the lesser of these three: the amount that was actually designated by the church, the amount you actually spent on housing-related expenses, or the fair rental value of your home. Very quickly, let's talk about the fair rental value. It's as if you could rent, what could you rent your home out monthly for if it were fully furnished? Get that value, multiply it by 12, and then add the amount you pay every year for utilities. That very quickly is the fair rental value. So understand that as we refer to this as we're moving forward. But again, the IRS limits you to the amount designated by the church, the lesser of the amount designated by the church, the amount spent, or the fair rental value. So we've got a lot of pieces of the puzzle to the tax world that we're starting to piece together now. So hang with me. We're going to put these pieces together, and it's going to make sense in just a moment. Again, how much can you exclude from income on the housing allowance? It's the lesser of the amount designated by the church, the amount actually spent on qualifying housing-related expenses, or the fair rental value of your home, assuming you live in or rent your home. Again, here's a minister's W-2. You have the housing allowance of $20,000. The total ministerial compensation package was $80,000, so the W-2 income is reduced by $20,000 to $60,000. Now again, if this is included on form, the $60,000 is included on Form 1040. And if you ignored the housing allowance, you would only pay income tax on the $60,000. Well, is the IRS going to allow you to exclude this $20,000 just because it was designated? As we've been talking about, the answer is no. It's the lesser of these three: the amount designated by the church, and in the previous example, that was $20,000. Let's say the minister spent $25,000 on housing-related expenses, but the fair rental value plus utilities is only $15,000. What's the amount the minister can exclude. Remember, right now he's excluding $20,000 because that was taken off the W-2. But if it's the lesser of these three, you're correct, he can only exclude $15,000. So the minister is going to have to take the $20,000 that was designated, subtract the limiting factor, which is the fair rental value of $15,000, and the minister is going to have to add back on his personal income tax return $5,000 of taxable income. Another example, let's say Reverend Newby is going to make a lot of repairs on his home in the upcoming year, and so he thinks he's going to spend about $60,000 on housing-related expenses. So he goes to his church in December and says, I want $60,000 designated as my housing allowance. And we get to the end of the year, and he actually spends $60,000, and because of all the improvements he made, the fair rental value jumped up to $40,000. Well, remember, Reverend Newby had a compensation package of $80,000. He designated $60,000, so what is his W-2 going to be? $20,000. That's it. But remember, $60,000 was designated. The IRS will only let you exclude the lesser of these three, and the lesser of these three is the $40,000 fair rental value. So the minister has to take the $60,000 that is excluded from his W-2, subtract the limiting factor of $40,000, and that means he has to add in $20,000 on his personal income tax return. It would be the same as if he had a W-2 really of $40,000. The moral of the story, usually you cannot exclude more than the fair rental value of your home. And let's look at that. The designation that you can designate by the church, go to the church and have them designate, is like the wind. I mean, you can take that up and down. In our previous example, it was $20,000 in one year and $60,000 in the other year. So this amount can really fluctuate. The actual amount that's spent every year, that can go up and down as well. It just depends on how many housing-related expenses you're going to incur from year to year. Now, the fair rental value, though, is really fairly steady, usually. If market conditions don't change drastically, then the fair rental value and the amount of, which includes the amount of utilities you pay, is going to remain fairly steady. But regardless of how much you designate and regardless of how much you spend, if it's more than the fair rental value, you're not going to be able to exclude it anyway. And if you spend less than your fair rental value, if you designate your housing allowance as the fair rental value, it will ensure that you're taking full advantage of the amount you can exclude from income. So we recommend that you designate your housing allowance to be the fair rental value, which is if it is fully furnished plus the cost of utilities. Again, we're assuming that you're owning or renting your home. How do you determine the fair rental value? Through a professional realtor. We would recommend that you seek the professional advice of a realtor. Tell them you want to find out how much the market would allow you to rent your home out if it were fully furnished. They'll likely give you a range from $2,000 to $3,000 for instance, and of course you'd want to choose the higher amount because that's the more you could possibly exclude from income. And make sure you get that documentation in writing by the realtor and keep that in your records. And if there are market fluctuations from year to year, then you might want to get that done every year, or if the market fluctuations don't change that much, get it updated periodically. What if you live in a church-owned parsonage? Should you designate a housing allowance? Obviously, you're probably not going to have as many expenses related to the home as you would if you owned or rented, but absolutely you should designate a housing allowance. How much? Estimate about how much you're actually going to expend in a year, and I would probably add a little bit extra for the unexpected. Go to the church and have them designate that amount as a housing allowance. Then once you get to the end of the year, compare that amount to the amount you actually spent. If you spent less than your designation, then you're going to have to add some back into income on your personal tax return. And that's really a good scenario for ministers, is to be adding back amounts into income, because that tells you that you're taking full advantage of the housing allowance. You would rather this be high than low, because if you overspend your housing allowance, you've left tax dollars on taxable income on the table that you didn't need to include in taxable income. Some housing allowance questions very quickly. Can retired ministers have amounts designated? Yes. Inform your denomination. The normal limits would apply in regard to how much you can actually exclude. Is it subject to seek the tax? We would ask you to seek the counsel of your tax advisor. If it's really legitimate retirement income, generally it's not subject to self-employment tax. Can ministers with a Schedule C designate? Let's say you get a W-2 from a church. Well, you might also do funerals or preaching or perform worship services outside where you get income personally from the churches. Well, if you get it in communication with those churches ahead of time, you can have them designate that income as a housing allowance. Of course, again, you would have to be able to apply the normal limits along with your normal housing allowance. But income earned on Schedule C as a minister, if you're subject to, have not opted out, you are subject to self-employment tax on that income. And one other question on housing allowance exclusions. Can you exclude the income on the state return? Usually that's yes, but, and that's a big but, check with your tax advisor, because some states may not conform. Let's talk about actual housing expenses just for a moment. Let's say the fair rental value of your home is $40,000, and so you go to your church and you have them designate that $40,000 as a housing allowance. But you actually spend $30,000 that year. How much can you exclude from income? It's the lesser of the three, and you're correct. The amount is $30,000 that can be excluded. Remember, you're excluding $30,000 from income. What's the IRS view on that? It's a $30,000 deduction from income. So if you're deducting $30,000, what does the IRS want? Substantiation for that deduction that you're taking on the personal tax return. So you must document, and document. If you claim that you spent $30,000 in actual housing-related expenses, show me, is what it means by documentation. Keep the receipts. Keep your mortgage statements. Keep receipts of furniture that you purchase, of landscaping that you make, supplies that you purchase for the home. Keep the documentation. Great records will help you possibly have no changes upon IRS audit if you were ever audited. And having great records will help you sleep better at night as well. What housing expenses, what's included in housing-related expenses? Some are self-explanatory. Mortgage payments that you make, real estate tax you pay, repairs on your home are going to be deductible. Some other yes items, telephone charges, internet access fees are interestingly considered utilities. Homeowners' dues, household cleaners, pest control are deductible. Home equity interest is generally deductible if it's related to fixing up your home. If you take out a home equity line of interest and for college expenses for your children, that is not deductible. No items: cell phones, diapers, cleaning services, domestic help, second homes, vacation homes, business property. Now, very quickly, now let me talk about second homes, because there could be an instance where that might be deductible on a second home. We would ask you to talk to your tax advisor. Let me give you for instance, we have ministers that live in Indiana that have a home 6 months in the summertime in Indiana, but in the winter they migrate down to another home that they own in Florida. Well, they're living in both homes. Can they deduct those expenses on both homes since it's their primary residence for 6 months out of the year? We'll let your tax advisor answer that question, so we'll move on. That's another question to consider. Okay. The double dip. You've heard about the double dip on a minister's housing allowance. Well, that refers to the mortgage interest and the real estate tax. If you're preparing your income tax return, once you have adjusted gross income, let's just go to the next slide, of $80,000 or $60,000 on the other example, and you get down to taxable income. Well, here you have your adjusted gross income. Remember, the housing allowance reduces your income subject to tax. And if you have mortgage interest and real estate tax included in that deduction, then you're deducting it here. But look at this line, line 40, itemized deductions on Schedule A, or you get a standard deduction, whichever is higher. Normally, if you're owning your own home, you'll have mortgage interest and real estate tax that you'll be able to deduct. Also on Schedule A of itemized deductions are contributions, a state income tax that you pay, medical expenses if you have enough to deduct. So a lot of deductions available on Schedule A. So let's say you do file Schedule A and you do deduct right here the mortgage interest and the real estate tax again. Not only is it being deducted on line 40, but it's being deducted here. That's called the double dip, and that's great news, and it tastes very good. Is the housing allowance here to stay? The minister's housing allowance. There was an organization in California that recently brought suit in court that the housing allowance was unconstitutional. To make a long story short, the organization has since relinquished their suit, and it is no longer there, and it's been rescinded, and so the suit is no longer applicable. There's a code section in the IRS Code 107 and that refers to the housing allowance, and it's very exclusive in that it's for ministers of the gospel. So in this day and age, and with certain people and institutions looking at that very closely, they're trying to either open it up to other people or declare it unconstitutional. It's been around for decades. President Bush signed a law in 2002 to solidify it, so it's very, it'd be very unlikely that it would be declared unconstitutional, but it is being looked at. A side note on how much can be excluded by the IRS of a housing allowance. We said that there are three amounts, the lesser of the three. There is an additional one. It's reasonable compensation. Usually it's not a factor because usually the reasonable compensation amount is not going to be the lesser of these, and so it's usually not brought into the equation. So, but just keep that in mind that there is another one out there. So let's summarize on the minister's housing allowance. We've talked about a lot. We talked about who is eligible to receive a housing allowance, how the housing allowance can reduce income tax, that it's very important to have an amount actually designated, and how to go about having the housing allowance designated. We talked about the W-2 and how it changes and decreases the income reported on a W-2. How much you designate as a housing allowance is very important, and we used an understanding of the IRS exclusion limits to help us get to an amount that should be designated. And we also talked about the fair rental value of a home that's owned or rented. We talked about a church-owned parsonage, actual housing expenses, what's included in housing expenses, and the importance of documenting the deduction that you're claiming for housing-related expenses. So we've talked about a great deal about the minister's housing allowance, and we have crossed the finish line in our discussion of minister's housing allowance. So well done. Thanks for hanging in there, and we're just about getting to the end of the webinar. Let's quickly talk about just a few more slides, and let's talk about self-employment income for ministers. Remember that ministers are treated as employees for income tax purposes, but as self-employed for Social Security and Medicare tax purposes. And again, looking at a minister's W-2, they have wages of $80,000, and the Social Security wages and Medicare wages are zero, and there's no tax. Well, what's included in the income, the self-employment income, in computing the Social Security and the Medicare tax for a minister? Remember, they pay self-employment tax on Schedule SE on line 56. Well, this tax is computed on income on Schedule SE. Well, how do you know what income to include on Schedule SE? And very simply, in our example today, it's just essentially reportable ministerial income is included in self-employment income. Let's look at an example. Compensation package for a minister is $80,000. He had $20,000 designated as a housing allowance, and his W-2 is $60,000. One might think that because his W-2 is only reporting $60,000, that self-employment income would only be $60,000, and the housing allowance would be excluded, but that is not the case. Here's the housing allowance of $20,000 and the W-2 of $60,000. And all of this is self-employment income for self-employment tax purposes. So this $80,000 is included on Schedule SE, and Schedule SE drops you through the computation of the tax. There's a discount rate, we'll call it a discount rate of 0.9235. We won't go into that, but you multiply the self-employment income by that rate, and then by the self-employment tax rate of 15.3% to get your self-employment tax. Did you know on a church-owned parsonage that there's a fair rental value of that home that the minister is receiving for living in that home? Now, for income tax purposes, the value, that fair rental value, is not taxable. But for a minister living in a church-owned home, the fair rental value of the benefit they're receiving for living in that home is subject to SECA, is included in SECA income, and subject to SECA tax. Many ministers don't realize that. So a minister has to compute what the fair rental value is, and on this side you want it to be as low as reasonably possible, and then it's added to self-employment income. Not taxable, federal taxable income, but it is added into self-employment income. And then you figure your tax. Keep that in mind if you live in a church-owned parsonage. Let's talk about the self-employment tax rate. The usual rate, as we have talked about, is 7.65%, consisting of 6.2% Social Security and 1.45% Medicare, and the employer duplicates that amount. For 2011, President Obama gave us a tax decrease of 2%. The employee's portion of Social Security, normally 6.2%, was dropped to 4.2%. So the employee, instead of paying 7.65%, is only paying 5.65% for 2011. The employer still has to pay the 7.65%. So for ministers filing their 2011 income tax returns, and they're paying SECA, they're going to be paying 13.3% rather than 15.3%. This is only for 2011. There's talk on the Hill that they might try to extend this, but right now that has not taken place. So in 2012, there's going to be a 2% tax increase. This is not only available to lay employees, but also to ministers and the self-employed. Let's talk about opting out of self-employment tax. Ministers can opt out. If they have $400 or more of ministerial income, after the second year they do, they have within 2 years to be able to opt out of self-employment tax. Why would a minister want to elect out? Just read Form 4361. It's not an investment decision, and many ministers wrestle with the issues on Form 4361 as to whether or not they want or should opt out. Remember, it's forever once you do. There was a window of opportunity a few years back for ministers who had elected out to elect back in, but that window has closed. So if you do elect out of SECA, it's forever. Here's a link to the Form 4361 on the IRS website. I encourage you to read that or look at that if this might be applicable to you. Let's talk very quickly about reducing SECA income and SECA tax. Did you know that UBI reduces SECA income and SECA tax? What's UBI? It is unreimbursed employee business expenses. A quick example, if you have $1,000 of business expenses related to the church that you incurred personally, but you were not reimbursed by your church, did you know that $1,000 can be subtracted from SECA income before you compute your SECA tax? It can. And that's one way for ministers to be able to reduce their SECA tax. So if you have unreimbursed employees' business expenses, please document those expenses, the time, the place, the business purpose, keep good records. Bring that to your tax preparer, and they can help you reduce your SECA income. Oh, tax grief. Let's talk just a few things about tax grief. Actual housing expenses can change from year to year, and if you're not understanding of that, that can add some ouch factor when you're filing your personal income tax returns on April 15th. Very quickly, an amount designated is $40,000 by for the housing allowance by a minister actually spent and able to exclude from income is $30,000. They're adding back into income $10,000, the difference between the two, right? If you go over here in this example, designated $40,000, but only spent $10,000 this year rather than $30,000 in the following year. The amount they're able to exclude is $30,000, the $40,000 less the $10,000. Well, they actually excluded had to add back into income $10,000. Now they're adding back into income $30,000. That means taxable income went up in the following year by $20,000 just because the minister spent less on his housing-related expenses. If a minister's not tracking that, they get this surprise when they file a return. The taxes go up, and it's ouch. And we run into this a lot with ministers. So please be aware of that. Some more tax grief. Cost of living increases. Ministers will get cost of living increases that will increase their SECA income and maybe their federal taxable income. Yeah, they'll get that, but they won't compensate by withholding more or paying in more estimated tax payments. They get to the end of the year when they're filing their tax returns and surprise, they owe more tax this year, and they're wondering why. So make sure if you get cost of living increases or you know you're going to have income increases, it's going to increase your taxable income, make sure you pay in more withholding and estimates if you don't want to have surprises or a balance due. Other things that can cause tax grief, child care tax credits can be gone. and that's $1,000 per child. Exemptions can decrease when dependents leave the nest. Education credits can disappear. Tax law changes can come about that you're not aware of, and all that can cause April 15th heartache. So watch that. Well, in summary, we've talked about a lot on this webinar today. We've talked about how ministers are surprised and the tax world and everything that's going on in there, and how income tax is paid and how FICA tax is paid, and we talked about how ministers are treated as self-employed and pay SECA tax. The housing allowance was discussed, as well as what's included in self-employment income, how ministers can opt out of self-employment tax, methods for reducing your SECA tax, and we just talked momentarily about some tax grief and how to avoid that tax grief. And so that brings us to the end of our webinar today. I'd like to thank you for joining. This is the contact information. If you have questions regarding this webinar, feel free to shoot me an email. We have others in my office that work right next to me. John Butler is our tax counsel for our firm, very gifted and knowledgeable in ministers' tax issues, as well as Ashley Peabody, our tax senior. And so please feel free to email me. If you don't get me, then you can feel free to email one of them a question regarding the webinar. And finally, we have future webinars coming up in January. Again, a tax update, personal tax update for the year and how that might affect ministers. And in February, we're going to be talking about tax filing tips. And we're looking forward to being able to spend time with you. I'd like to thank Robert Lundy of the American Anglican Council. He was instrumental in getting the webinar presented and moving forward, and he's just been great to work with, and I appreciate all his help. And so I'd like to thank him and the American Anglican Council. And that ends our webinar today. May you have a blessed day, and we'll see you in January.